All right, let's jump right into it. Grab your sell-side analyst hats because today we are heading straight to the workbench. We're going to conduct a rigorous, fully documented fundamental valuation of Guardforce AI. If you love tearing apart balance sheets and testing the absolute limits of financial modeling, you are in the exact right place. We're building a comprehensive view of this company using nothing but cold, hard data. To uncover the true intrinsic value here, we're going to run the financials through a strict diagnostic gauntlet. We'll start with the current snapshot, move through absolute valuation models, tackle the residual income approach, look at sum of the parts and APV, test relative and asset valuations, and finally, deliver our verdict. Section 1, the current snapshot. Let's establish our baseline for what is, frankly, a rather distressed asset. First up is scale. Guardforce AI is a deep microcap. We're talking about a tiny $18.12 million market cap with shares trading hands at just 58 cents. That size alone injects a massive amount of fundamental risk into any model we try to build. And man, that risk is super clear when you look at the historical price action. It's been absolutely brutal. Down 88% in 2022, a drop of nearly 57% in 2024, and a trailing 12-month return of negative 45%. The market has been aggressively discounting this stock for years. But here is the fascinating paradox at the heart of this company. On one hand, their liquidity is actually fantastic, a current ratio over 5. That means they have more than 5 times the cash needed to cover their immediate liabilities. But operationally, it's a catastrophe. Return on invested capital is negative 35%. So they have the cash to survive the short term, but the underlying engine is just bleeding out. Section 2. Absolute valuation models. With that paradox in mind, let's see what our heavy quantitative tools tell us, starting with the discounted cash flow. To run a proper DCF, we've got to set our assumptions. They generated nearly $37 million in revenue over the last 12 months, but free cash flow is profoundly negative at minus $3.08 million. Because of that massive microcap risk, we essentially have to apply a punishingly high cost of capital. Let's peg it around 12%, along with a standard 2% terminal growth rate. So what happens when we plug that in? The model completely breaks down. You just cannot discount negative future cash flows into a positive present value without making some wildly optimistic guesses about sudden future profitability. It's a mathematical fail. Intrinsic value here is inherently negative. Let's try grabbing another tool, the dividend discount model. This values a company strictly based on the cash it returns directly to shareholders. And we're skipping it. The data shows 0% dividend growth rate. Without a stated, consistent dividend policy, this model is completely inapplicable. Section 3, the residual income approach. Since standard cash flow and dividend models are failing us, let's pivot. This approach is much better suited for companies with wildly noisy inputs. Let's reverse engineer this. We start with our $18 million market cap, factor in a deeply discounted price-to-book ratio of 0.37, and boom! We derive an implied book value of roughly $48.97 million. Now, nearly $49 million in book equity sounds incredible for an $18 million company, right? But wait, this model penalizes you if you don't earn your cost of equity. They have a negative net income of over $6 million. Once we subtract our baseline equity charge from that, the residual value goes up in smoke. They are actively destroying wealth faster than that equity base can support it. Section 4, sum of the parts and APV. Absolute models are striking out, so let's see if slicing things up works any better. Sum of the parts is exactly what it sounds like. If the whole is broken, maybe we can find value by valuing the individual business units separately. Actually, scratch that. I've got to be transparent with you. The source filings just lack the discrete segment reporting we need. We can't break out what we can't see, so we have to skip this one too. What about adjusted present value, separating operations from debt tax shields? Well, look at the debt-to-equity ratio, 0.09, almost zero debt, and a 0% tax rate. That means there are virtually no valuable tax shields to add back. Combine that with the negative firm value from their cash burn, and APV is a dead end as well. Section 5, relative and asset valuation. We are seriously running out of lifelines here. Let's see if competitors or pure liquidation hold the answers. Peering over the fence doesn't help much either. Their PE ratio is negative 1.32. You literally can't compare a negative PE to healthy peers. And while their EV to EBITDA sits at 1.17, which looks incredibly cheap compared to a normal 8 to 10 multiple, it's completely skewed by their distressed enterprise value. Standard multiples are basically useless for us today. So we arrive at our potential savior, asset-based valuation. This asks a very grim but important question. What if we just locked the doors, sold the desks, paid off the debts, and handed whatever is left to the shareholders? And here it is. This is the big revelation of our entire analysis. This is the only model showing us real upside. Because the market is pricing the equity at roughly 1/3 of its accounting value, and their current ratio is massive at over 5, we know there's actual cash there. The dead, liquidated parts are quite literally worth more than the living operating whole. Section 6, Final Analyst Verdict. Let's pull all this rigorous diagnostic testing together. We're looking at an incredible dichotomy. Operationally, our models are screaming value trap. The negative returns and bleeding cash mean the business destroys value every single day it stays open. But strictly from a balance sheet perspective, it is a classic deep value liquidation play. It is trading at a massive discount to the cash it holds. Which leaves us with this final thought. You've seen the hard data. The operations are bleeding out, but the balance sheet is surprisingly flush with short-term liquidity relative to its tiny market cap. So, is this a dangerous trap you should avoid at all costs, or the ultimate contrarian liquidation play, just waiting for an activist investor? I will leave that for you to decide. Thanks for joining me for this explainer, and keep digging into those numbers.